Thank you for staying on the line whilst we were dealing with the glitch between our sponsors and the JSE in getting the SENS out. As per the regulations, I'm advised that we were not able to come online until the SENS was out for the presentation. My name is Sandile Nomvete, and I'm the CEO of Delta. I will be taking you through the first half of the presentation for the 6 months ended 31st August 2019. If we just turn our slide to page 4, just some introduction to Delta. You would have seen that our assets under management have gone down slightly from the 11.8 billion, which we had at full year, to 11.3 billion. On the right-hand side of the presentation, our sovereign underpin has gone up slightly since February 2019, from 79% to 80.7%. This is as a result of some disposals that were basically undertaken during the period. Our core and dominant area is still Pretoria and CBD and Durban CBDs, where we still basically have a dominant presence. The key number for us that we've been basically monitoring over the years is the 109 million rand, which we have managed to maintain during the period. I do understand that obviously most of you may not have had time to read through the presentation or the SENS announcement, so we will try and go through as much detail as possible to make it, to cover as many angles as possible. If we turn to page 5, there has been an exceptionally difficult trading conditions have continued, as has been documented in previous results presentations. I think the policy uncertainty at DPW is something that we've continued to try and get more clarity on. Ourselves as management have had a meeting with the minister, one of the first, in fact, if not the first landlord to actually meet the new minister, to try and make sure that the delivery and the impetus from a delivery perspective from DPW continues under Minister Dalil. And I think we did have quite a productive discussions, and I'll touch on that discussion a bit later on. We have made some headway with regards to lease renewals. During the period, we've also signed some new tenants and extended expiring debt facilities and successfully disposed of some assets held for sale. Even though this is not going at the pace that we would ideally have liked, given the tough economic environment. I think banks are now wanting serious equity for any prospective buyers to participate, to inject in the possible acquisitions. Considering that the current tough trading environment and cognizant of the increased working capital requirements and contractual CAPEX commitments on the back of the leases that we have already signed, the board and management deemed it prudent to declare an interim distribution of 12.19 cents per share. The leasing progress, initial bulk, if shareholders remember, we historically had announced that we had 227,000 square meters of bulk leases that we had to renew. To date, we have signed and confirmed and sealed and are already committed 95,500 square meters of that for an aggregate period of between 3 and 5 years. The remaining balance of the 227,000 square meters of 131,000 square meters includes 4 major leases. These 4 major leases total 96,000 square meters. 2 of these leases we were hoping to have signed by today. The tenants have already committed and written to DPW their intentions to renew and to stay in that particular building that they share for a further 5 years. And that GLA is circa 65,000 square meters of GLA. So if you add the 95,000 and the 65,000 that we anticipate that whilst we are on roadshows will be committed, I think that will definitely put us more than 2/3 by our calculation of the bulk GLA that was communicated to the market. Vacancies have unfortunately increased slightly, particularly in Bloemfontein continues to be a tough note for us. But the COO, Otis Shabalala, will take us into more detail in that. And we managed to lose 1 tenant in Pietermaritzburg at our Capital Towers building. And we already have got plans underway. We've got 2 tenders and 1 tenant that has been basically had their buildings condemned that are urgently looking for space in Pietermaritzburg that we anticipate. Our anticipation is that we will fill Capital Towers before our next reporting period. UNISA in the Joburg CBD is another building whereby we managed to lose a tenant. And this is primarily because UNISA was actually offered a free building by the city of Johannesburg to basically own, and they can refurbish for themselves as part of the city's initiative to try and fill out vacant buildings. So I think the Otis will obviously go into more details around some of the plans that we do have around the increased vacancies and what plans we have in place. If I turn over to page 6, on the funding side, Delta's long-standing banking partners approved extensions totaling circa 2.8 billion rand in expiring facilities during the period, with further extensions concluded post-interim reporting. And Chanel will be able to give you a lot more detail in terms of what pricing we have been getting and where we see this going forward. The interest rates have obviously come down, have become a bit more competitive, and again I would leave that to Chanel to give you a lot more granularity around some of the pricing that we're seeing coming through. On the disposals, management remains cognizant of the tough economic environment, and we will only announce unconditional transactions. I think we've probably been a bit too conservative. In terms of not mentioning, some of the transactions that have come across our tables. We have received 1 or 2 unsolicited bids on some of our properties, but we will discuss that under the Chief Operating Officer's section in a lot more detail. I think BE opportunities to acquire, and secure long-term leases, as fund managers will recall, DPW came out with a new leasing policy, which the whole sector, is still trying to figure out. In January of 2018, as we had indicated to the market that, for funds that are a lot more highly empowered, they're getting longer-term leases. What we've seen from the leases that we have renewed is that Delta is receiving between 3 and 5 years. It looks like the externalized management company that we do have, historically, which used to qualify us for the 10-year leases, they are ignoring at this stage and are purely focusing on the ownership element at this particular stage. So these are some of the questions that we have obviously put through to the Minister, and we do anticipate that at our follow-up meeting with her, she will be able to give a lot more clarity in terms of which direction we should be moving, particularly with recognizing some of the black-owned listed companies, because obviously this has a huge impact in terms of our whale going forward. That leads me to the next point regarding our proposed merger with Rebosis. In line with Delta's strategy to introduce an element of bulk and diversification into its portfolio, we are continuing to make good progress on the proposed merger. To date, the parties have made good progress, as I've already mentioned, and we think that we have reached a couple of milestones, which I think we obviously have managed to share with the top 5 shareholders as per TRP regulations. But some of the points that we have signed off on, or basically meeting of the minds, obviously subject to the respective board subcommittees, is the preliminary due diligence has been completed. The initial optimal capital structure has been determined, and the methodology for the share swap has been penciled in. We have taken comments from those shareholders that form part of the allowance from the TRP regulations, and we basically think that what we will be presenting to our respective boards, and hopefully if those respective boards do approve the transaction, we should then be able to communicate with a lot more detail to the broader market. However, I must include that this methodology on the share swap does include the funding gap to achieve an acceptable loan-to-value, which which both parties have pre-agreed upon, to make sure that the merged entity post-merger obviously has a very healthy balance sheet, particularly given the current economic environment. As I've already stated, a more formal announcement on the specifics relating to the above will be made in due course. We are aware that a lot of the fund managers and shareholders are very anxious to get to the detail, and we are working as hard as possible to try and make sure that we conclude this period as soon as possible. It is our intention that hopefully in the not too distant future we will be able to, subject to board approval, announce the full terms of these of the transaction in due course. I would like to hand over now to Shanil Maharaj, who will take us through the detailed financial review during the period.
Thank you, Sandile, and a warm welcome to all of our stakeholders that are dialed in. I think as Sandile has articulated in the business update, it's been a very difficult trading environment, and from a finance perspective as well. Just referring you to slide 9, that gives you a summation of some of our performance metrics within the business. If you just look at the facilities that we've extended, 2.8 billion rand worth of expiring facilities. Again, just to reaffirm that these are extensions, not permanent refinance. And a lot of this is obviously linked to the lease renewals. So once we do have the more permanent or longer lease renewals in place, that will put us in good stead to obviously have these facilities refinanced on a longer term. With the refinance coming into play, we obviously will have to do that and manage our debt expiry profile, because as you would imagine, there's a significant amount of debt that's sitting in current. Our intention is obviously to extend the expiry profile between 3, 4 and 5 year funding, and hopefully that will bring down the cost of debt as well within the business. From an LTV perspective, you would note from financial year end, we've had slight progress that we've made. A big part of that does come out of the cash that we are generating and we have accumulated. So once the dividend payment is made, you will see a marginal increase in that value. However, the LTV in the business does remain a core focus area for us, and closely linked to the LTV is the leases that are signed and whatever value that unlocks from the property portfolio. As we have been saying to the market, and I think Otis will re-emphasize that under valuations, is that once we do have a significant part of these leases signed, we would look to formally revalue the portfolio, and hopefully it can create some headroom for us on the loan to value. Interest cover ratio, so at 1.9, still fairly healthy. However, it has dropped below the 2 covenant that we've had in place. We have engaged with our funders, and a lot of our funders obviously understand, due to the extensions and the higher interest rates and fees that come with these extensions, that it has created a breach of the interest cover ratio. However, all of our funders, to emphasize again, have been very supportive. They have given us a temporary reprieve from the covenant of 2, and 1.9 is still viewed fairly healthy. We are hoping, again, once the facilities are signed to, and once we've unlocked some of the value that sits within the vacancies that have increased, that this ratio will be able to be above the level, above the 2 that we've had historically. From a debtors perspective, 28 days is slightly down. So our current debtors, we are managing fairly well. You will, however, see that it's more a challenge with some of the arrears that we've had, which has been on the books for the better part of about 12 to 15 months. We are engaging robustly with DPW, and as of 2 weeks ago, as the executive team, we've got involved together with our property managers to try and see if we can add a bit more pressure and try and get some finalization so we can collect some of the cash that's tied up within our debtors. Property operating margin at 67.2%. It's obviously translates into a gross cost to income ratio of 32.8%. You will see that our gross cost to income ratio has ticked up marginally, but as expected. There has been slightly higher municipal costs, and that is one of the key factors that has driven the gross cost to income. Fixed debt at 44.1%. It's not ideal, but as we've mentioned to the market, is that we're in a bit of a conundrum at this stage with the extensions, because obviously a lot of the facilities, or a big portion of the facilities that have been extended, are linked to prime, and when we formalize these facilities, they in all likelihood will be 3 months JIBAR linked. So it's a bit premature for us to go and take out any fixes at this stage, because we're not sure what the complexion of our rates are going to look like on these facilities. And that's one of the reasons this has ticked down. A second reason for that is that some of these facilities that we have extended have obviously, we've lost the fixed status. So all of our facilities are now floating. So we don't have that luxury of having any more fix that gives us a benefit around this metric as well. Just flipping over to page 10, and this is a summary of the financial review, some of the important points. From a revenue perspective, if you just look, compare it August 2019 to August 2018, there has been a reduction in revenue, and I think as we've said to the market before, some vacancies, there has been a creep up in vacancies. Sandile has emphasized that in his presentation as well. Together with that, we've had slight reversions on the 90-odd thousand squares that we've signed. That hasn't been as significant, however, as the vacancies that have come into the portfolios, particularly from Capital Towers, Unisa House, and some of the assets within the Bloemfontein portfolio. Otis will give us a bit more color on that later on. Net property income is down 18 million. Again, it's all of the factors, between the revenue coming down, also with regards to some of the property operating expenses. Like I said, there's been a slight tick up on the gross cost to income ratio, has impacted that number. Finance costs, I think that's where you will see the most significant impact across our financial statements. And again, it's linked to the extensions and the higher interest rates. There's also fees that have come into the play, as you would imagine, with extensions, where we are extending facilities twice in a financial year. you are obviously paying fees twice as well, and the fees that are correlated to extensions are a lot more costlier than fees that come with a permanent refi. So that's something we're very cognizant about, and it's another reason why we're really pushing to make sure that we formalize and sign the leases. I've touched on the cost-to-income ratios. Investment property is down about 45 million, and that's purely due to the disposal of Top Trailer Site 2 that was done during this period. Investment in listed securities, that's our investment in GRIT. You would see there's been a marked downward movement since financial year end Feb 2019. At Feb 2019, the value of the shares as listed on the JSE was 19 Rand 35. At the end of August, that has deteriorated to 17 Rand 50. So you're looking at quite a substantial impairment, and you will see that impact when you look at the financial results and the detailed income statement. A big portion of our fair value adjustment is linked to the downward valuation of our investment in GRIT. Around the borrowings has moved down slightly from 5.258 at Feb 19 to 5.21 at August 2019. And some of the major factors that are responsible for this move is facility fees that we've capitalized. There's been a smaller element of foreign exchange loss. For those stakeholders that recall, we do have a dollar-denominated Bank of China loan. So with the deterioration in currency, we've also taken a bit of forex loss on that loan. In addition to that, and as we've told the market before, there are 3 facilities where we are amortizing capital. Again, it's a factor of the leases not being in place and some of the increased vacancies. The quantum is a lot lower, but it does have a financial impact, and it's also quite prevalent if you look at the cash flow statement. If you just look at I've touched on the LTV, weighted average interest, it's moved very marginally from 10.2 to 10. That's because some of the extensions that we've done post May 2019, we've managed to reduce and get a bit more favorable rates, which was obviously based on the back of the 90,000 squares of GLA that we signed with DPW. Still not the rate, our target rate. If you look at our business historically, we've always been in the range of about 8.9 to 9.2%, and we're hoping with our leases in place, we are able to get back to those glory days of 9.2, 9.3%. Average debt expiry, again, that's ticking down. It's just the passage of time until we do permanent refis. The debt fixed expiry, that has actually increased. So what we've done there is that post financial year end Feb 19, there was good value in the interest rate swap market. We did take quite a substantial swap of about 650 million, and the rate was around 7.8%. So it was about 70 basis points above JIBAR at that stage, and we thought there was good value. Obviously unsure as to where interest rates were heading, and it also helped us prong up our deteriorating fixed floating ratio in the business. Net asset value, it's almost aligned. There's been a slight movement, and one of the major factors is obviously the fair value adjustments that are coming through the income statement, being the fair value downward on the investment in GRIT, and together with fair value adjustments on the disposal that we've had. On page 11, this is just giving you a reconciliation between the net property income and the distributable earnings. As you will see, distributable income for the period, 217.7 million, and that translates into distributable earnings per share of 30.48 cents. As Sandile has mentioned in the business update, from a board and management perspective, we obviously took quite a prudent approach, because as you would infer, with the leases being signed, there comes a lot of CAPEX obligations with those leases. And unfortunately, where we find ourselves at this stage with the extensions, we don't have any headroom for new facilities. So a lot of the CAPEX that we're having to do in the business is coming out of cash resources, but obviously not sufficiently enough, because there is quite an aggressive CAPEX pipeline. So I think we've taken the responsible decision to say, listen, until further leases materialize at this stage, we're holding a portion back to just facilitate and invest CAPEX in the assets that we do have. And that translates into a distribution of 12.19 cents per share. Page 12 is just a graphical representation of the distributions. From our perspective as well, obviously disappointing, seeing it coming quite extremely down. However, we believe that once the property fundamentals come back into the business with the leases being signed, we should see this distribution graph looking a lot different. On page 13, it's the distributable earnings bridge. That again just gives you a graphical representation of the slide that we've been through, and it just takes you from August 18, the 281 million that we did achieve at that period, to the 217 that we have achieved at August 2019, and it just demonstrates what has created value and what has eroded some of the value from a distributable earnings perspective. You will see the biggest portion of erosion comes out of the finance costs, which was expected with the extensions and the higher rates that were afforded on these facilities. On slide 14, that's a like-for-like net property income slide. And I think just to demonstrate it's done slightly different this time around, we've taken some guidance in terms of the way we actually translate some of the information on the slide from our colleagues at Standard Bank. And the like-for-like is actually a reversion of 3.3%. There again, a big part of the 3.3% does come from the vacancies on a like-for-like basis. Reversions have had a lot smaller impact. And yeah, here again, you know, if you look at our in-force escalations that we've had in the portfolio that was sitting in excess of 6%, we would obviously like to get to a stage where we are delivering that level of growth in respect of the like-for-like. On page 15 is just the balance sheet, the statement of financial position. I think I've covered in detail the movement within the non-current assets, which is particularly around the disposal. We've covered the investment in other assets. Other non-current assets in the business is basically property, plant and equipment, and the movement is a factor of the depreciation. Non-current assets held for sale, again, the movement again relates to top trailers. Net asset value, if you look at the net equity in the business at 6.635 billion. Non-current liabilities and current liabilities, I think if you just look at our non-current liabilities, the portion of debt that we have sitting as non-current is about 1.6 billion. Under current liabilities, there's 3.6 billion of the 3.9, which is obviously in the short term, less than 12 months, and that for us is a concern. However, we are working hard and fast to ensure, once again, that we can refinance these facilities on a more permanent basis. Slide 16, if you flip over, is the net asset value bridge. That, again, as we've demonstrated with the distributable earnings bridge, just gives you a graphical representation of 9.30 at August 18, down to 9.29 at August 19. You will see our operations, obviously, as expected, contribute quite significantly. And on the other hand, on the extreme, your dividends paid, the outflow, is obviously what sort of brings that down. On slide 17, that's just a debt summary again. It just gives you further information regarding the complexion of our debt. 4.5 billion rand of our debt is floating facilities. We've got revolvers of about 648 odd million, and that reconciles to the 5.2 billion rand worth of debt in the business. Interest rate swaps that we have is the 2 billion. So if you take your 5.2 billion and exclude your revolving facilities, and you apply the calculation of the 2 billion as a factor, you come to the fixed percentage of 44.1%. Slide 18, slide 19 again is just a graphical representation that depicts the split between our debt by funders, between the fixed and the floating facilities that we do have, and the revolvers. And on slide 19, that's just depicting the expiry profile that I mentioned from the statement of financial position. And as you can see, there's a substantial portion within Feb 20 that needs to be refinanced on a more permanent basis. Slide 20, again, I think I've covered most of this. It's just emphasizing the extensions we've done, the weighted average cost of debt at 10 with interest cover down to 1.9, our LTV, and just giving you a bit more color around the average debt facility expiry. With that, thank you, and I hand you over to Otis Shabalala.
Thank you, Shanil. Good morning, all. I'm here to take you through the operational side of the business. I'm looking to cover 5 key areas. One around our biggest client, DPW, just to give you an update on how we are doing there. And then I'll take you through the bulk leases that we've done, and then leasing on the balance of the portfolio. I'll also touch on the vacancies and the arrears and close it off with the disposals. I think from a DPW point of view, as the CEO alluded to earlier, we had a meaningful meeting with Madam Patricia DeLille beginning of July, just after our appointment, and we took some key elements that we wanted her to look into. High on that agenda was the leasing policy, which is a big impact on our business. And then we also highlighted the slow rate at which lease renewals were happening, and highlighted the arrears and the health and safety issues around the government leased properties. We are happy to say that following that engagement, it seems that she has sent an instruction to her people. There was a meeting scheduled for 30 October with SAPOA, IPD, and the CEOs, COOs, and the other executives of property companies, where the items that we highlighted were going to be discussed. Operationally, as our CFO alluded to, we had a high-level meeting with SIU and the government-appointed auditors, an entity called OMA, who are doing the whole recons for DPW. We took our entire portfolio and went through the arrears, and we are hoping for those arrears to start being settled. So we had a meaningful meeting with the OMA people. Just on the bulk renewals, you recall, when we started off, we had 59 leases totaling 227,000 square meters. We are happy to say we've managed to renew 40 of those 59 leases. They make up just under 100,000 square meters. Of those 100,000 square meters, 70% has been done on 5 years, and the balance 30% have been done on a 3-year term. So we're quite pleased with the 5-year term, which has seen our WALE starting to increase after a long time. Then there's about 131,000 square meters remaining. While that looks daunting, the bulk of that 131 is made up of 4 big leases that make up another 100,000 square meters. Of those 4 big leases, they are in 3 buildings. 2 are in the same building, which is a building in Pretoria. It's the Department of Defense and Correctional Services. They make up 65,000 square meters. We are quite advanced. We've been engaged in both DPW and the user departments, and we were hoping to have those leases renewed prior to the presentation. We really believe and truly believe that by the time we conclude our roadshows, by the end of this month, those 2 leases will have been renewed. That will see our bulk renewal going to over 75% in terms of the bulk renewals. The balance of 35,000 square meters has been agreed in terms of the tenure. We're not too happy with the clause in the lease agreement. Those have been renewed in terms of the default clause, where they sign a 3-year lease at prevailing rentals, which places a lot of pressure on fiscus. But we are engaging Madam DeLille and the senior management to try and bring down, get that 3-month exit clause removed from the leases. In other spheres of our business, leasing activity, we continue to do well. On the SOEs, we've done about 3 big renewals there. SARS Belleville in Cape Town, we signed up a 5-year lease for 16,000 square meters. We are also happy to report that SARS Randburg, where SARS initially gave up space, we've successfully renewed that lease for another 3-year term for just under 4,000 square meters. And we are quite in advanced discussions with SARS to take up an additional 3,000 square meters that they'd given up. In Johannesburg, the Joburg Water, they're in a building that we own, 12,000 square meters. We are quite advanced in renewing that lease over a 10-year term in Johannesburg. And then in Durban, we've got a building, a tenant in Embassy, the Road Accident Fund. We're looking there at a 10-year lease agreement, and they've gone out on tender, but we're well placed to win that tender, given that they're in our building. On the provincial leases, Bloemfontein remains a challenge, or the Free State. We continue hemorrhaging in that province on the provincial side of things. Our vacancies have crept up to just over 27%, leading to an increase in our vacancies in that node. But in other provinces like Polokwane, we are happy to report that we're doing quite well. We've got 3 big buildings in Polokwane that are provincially tenanted, Hensa, Pomoko, and Temo Towers. They make up just under 50,000 square meters. We've sent a proposal to the head of department and the local provincial public works. I think based on the fact that they were under treasury management at some stage, they are quite proactive in their negotiations. The bad thing there is that we're coming from a high base. Our rentals in some of those are close to 200 rand a square meter. We'll be coming down to about 140, but we're happy that we're quite advanced in our discussions to renew, and we're looking at minimum 5 years on those 3 leases that make up 50,000 square meters. In Pietermaritzburg, we've successfully renewed one of our buildings there. We've renewed the lease, Mayor's Walk, 5,000 square meters. We've signed them up on a 5-year term at 120 rand a square meter, 7% escalation. So we're quite pleased with that. And then at the municipal levels, which is the other sphere of government that we deal with, we've successfully renewed a lease, Shell House in Durban. We've signed up a 3-year lease. I think with municipalities, they're governed in terms of the MFMA Act. They cannot go for longer than 3 years at a time. So we've managed to renew for the maximum 3 years that we could do with eThekwini in Shell House. And then in Pretoria, Tshwane, Isivuno, we've got a building there, 22,000 square meters. The city of Tshwane has gone out on a tender for 105,000 square meters, and we've tendered for our building in Isivuno for the 22,000 square meters. That tender was extended to beginning of December, so we're looking forward to getting that lease renewed. What gives us comfort is that that building is located directly opposite Monitoria, the City of Tshwane House, which is a 2.5 billion rand project that the city built up. In terms of our vacancies, we've seen our vacancies increase. For the first time, they've gone up above the SAPOA national average. For the past few years, we've managed to be below that, but we lost 2 big tenants that we hadn't envisaged. We had a building in Gandhi Square in Johannesburg, UNISA, where UNISA were on the verge of renewing the lease for a 3-year term. They got offered a building by the city of Joburg, the ex-mayor Herman Mashaba, in terms of the Better Buildings project, offered them a derelict building where I think when the university did the numbers, it made sense for them to put money into the derelict building, into their own building. So we lost out on that. But the building is well located at Gandhi Square with a public transport route, and we are talking to some universities and colleges, the likes of Damelin and Menkosa, to take up that space. We are also looking at people that do resi conversions, given the good location of the building. So we're looking at a 2-pronged approach on how we can fill up that building. The other one that led to our vacancies increasing was the unforeseen movement of the Department of Health in Capital Towers. I think the Department of Health took a decision to move into one of their own buildings. And as the CEO alluded to earlier, we are looking at a couple of initiatives and tenders that are out there to refill that building. In Pretoria, we've got a building called Delta House, where we lost the Department of Health, a provincial one, just under 10,000 square meters. But we are happy to say that we are talking to a college, which is part of a listed education group, that are looking to take up that building. They are looking to lease it out on a 10-year term or with an option to buy the building. They had gone to tender and looked at a few buildings, and they've chosen Delta House in Pretoria. So that should see our vacancies coming down. If I can take you to page 22, on the first slide, we show that 3/4 of our income continues to come from government. And as I pointed out, it all comes from different spheres of government. I think only 40% of our income comes from national, and we are dealing with the issues there via the bulk lease renewal. And then in terms of the leasing activity, the experienced property management and the asset management team have really shown their resilience and successfully renewed 156,000 square meters, which is a big number given the challenging environment that we're in. In terms of new leases, we've not done too well there. We've done a small number, 6,500 square meters, predominantly small tenants, with only one in Durban of 1,500 square meters. Our WALE has gone up. I think from the past few years it has been coming down as we were trying to renew our leases. And with the success in renewing some of the bulk leases, we're seeing our WALE starting to increase. It's 1.7, and I think by the time we conclude the remaining bulk leases, we should see that number going well over two and a half years going up. And then in the last block, we show our weighted average rental that we are achieving across the portfolio. We're getting about 123 rand a square meter, which is a number that we're quite happy with. I think there has been talk that we are having lots of reversions, but that number shows that we are not doing too badly in terms of our lease renewals. In terms of disposals, we're only reporting on the ones that we've successfully concluded. There's been 2 small properties that have transferred that make up about 60 million. It is Top Trailers and the other 2 and 12 New Street, which is a building in Gandhi Square that was bought by the political party EFF for their head office. We have another 2 buildings that are that should be transferring end of November. Those are Broadcast in Mthatha. The buyer of that building secured a 10-year lease with National Public Works based on the fact that it's a 100% BE-owned company. So that building should transfer by the end of November. And we've received an offer for one of our industrial buildings, Protea Coin in Cape Town, which is under offer and should transfer at any time now. On page 24, if I can take you to page 24, and just draw your attention to 1 or 2 points there. If you look under office order, our vacancies are quite high at 34%, but that is driven primarily by the fact that this is a Sunning Hill node where we've always had vacancies. We had 3 buildings that were tenanted by Eskom. They vacated some time back. We are still trying to market those buildings and fill up the vacancies there. We've renewed 5,000 square meters with Eskom for 3 years. And then the other high vacancies are 54% on the industrial portfolio, but that is the Protea Coin buildings where we've sold one of the buildings, and we'll see our vacancies come down when that transfer takes place. If you look at Office Sovereign, which is our core, you'll see that our vacancies at 14%. This is the nodes that we're familiar with, our Pretoria and our Durban nodes. And then on the next slide, we just show a graph that reflects that 77% of our income still comes from government. And then if I can draw you to slide 26, just to show what we are trying to do and the initiatives that we are taking to try and fill up the vacant spaces there. I think it's quite a tough environment that we're operating in. There's a lot of competition for tenants in the nodes that we're operating in. We've had to bring some of our rentals down to try and secure tenants. We've had to go toe-to-toe with our competitors and start looking at offering beneficial occupation and throwing in some incentives even to the brokers to try and secure the tenants. So we continue doing all we can to try and fill up these vacant buildings. We've also now started looking at charging government interest on any arrears that are due. I think previously we've shied away from doing that, but we've now started looking at implementing interest where there's monies that are outstanding. And for the first time, we've also have really toyed around with the fact of handing them over. We've given them the benefit of doubt following the high-level meeting that we had. with OMA and SIU and the DPW, but we've taken a decision that if we don't get traction from that, we will definitely be looking at handing them over. On the next slide, on page 27, we touch on the policy certainty. We do know that Madam Patricia de Lille has got that top of agenda, and the meeting that was scheduled for 30 October has been moved. We know that SAPOA and other industry players are really taking a keen interest in engaging on that. Part of the agenda as well is to deal with the arrears, which is getting attention, and the backlog in the leases, which we know are all getting renewed. We're seeing the traction. I think the other big issue on the agenda is the rates and taxes, where at some point, some of the people at DPW do not want to pay rates and taxes. We think Madame de Lille, as an ex-mayor, understands the need and importance of getting rates and taxes paid. So we've been joined by SAPOA in that fight, and we're dealing with that. That meeting has been rescheduled for some time in November. And after our roadshows, we'll be joining that meeting as well. On page 28, we just show what I touched on the bulk renewals. We just show in detail there what we've done. I think the key number there is that of the 95,000 that we've renewed, well over 3/4 has been done over 5 years, and the balance over 3 years. And then we show you the big 4 leases that we're looking at. In a warped way, the delays in actually finalizing those big 4 is beneficial to us in that we're currently getting the higher rentals. But I mean, for our stakeholders, shareholders, and our funding partners, we want, as management, to rather have security of leases, and so we are pushing to get those leases renewed. On the next 2 pages, we just show the actual leases that we've done. We've purposely taken out the rental that we've achieved because we didn't want our competitors to come and see what rentals we are achieving with DPW. On the one-on-ones, we'll be able to share with you guys what rentals we're actually achieving on that. And then on the next slide, we just show the leases that we've concluded, including the Mayor's Walk and the Road Accident Fund, which is out on tender. I think a key metric there on page 31 is that we've done almost 750 million in terms of the leasing activity that we've done, the 156,000 square meters. On the next slide, on page 32, it just again talks about the SARS Randburg new lease that we've got. It shows the new leases of 6,400 square meters that we've achieved, and it shows what initiatives we're working on to try and retain tenants and attract tenants into our buildings. One new thing that we're doing is we're creating showrooms in the buildings where we have empty spaces to try and showcase when we take prospective tenants what we can achieve. Delta House is that empty building in Pretoria where the listed education group, which is Advertech, have indicated that they want to sign a 10-year lease with an option to acquire the building. On page 33, again, just show you the vacancies, highlighting where we've lost tenants, which is the UNISA and the Capital Towers, and then the initiatives that we are working on to try and fill up those vacancies. On page 34, we show on our valuations. As part of the merger, we are working on revaluing our portfolio. We've agreed the valuation methodologies on how we are approaching that, and it's ongoing, and it will help us in terms of having our valuations done on time for the financial year end 2020, Feb 2020. On the disposals, we just show the ones that have transferred, the ones that are under offer, and the ones that we've added on, which is the Bloemfontein assets on a provincial basis, where we continue struggling to attract tenants. On, if I can please take you to the CAPEX slide on page 37. We show you there what the CAPEX spend is going to be on the next 3 years and on the leases that have been renewed, the bulk renewals. The TI allowance of 78.5 million is lease renewal linked, and that is to be implemented in the next 12 months, and we are managing that with our funding partners. And then on the last slide of my part, page 38, on the greening buildings and the sustainability, we attended a meeting with the GBCA the Green Building Council, and we are looking at initiatives how we can introduce greening into our portfolio. We're looking at energy efficiency through efficient lighting and optimized HVAC upgrades and things like that. We've also, learned from the industry that there's other low-hanging fruits where we carry out CAPEX and TI on our portfolio. If the people that we work with on the soft services like cleaning, if they use material that is sustainable, we get points from that, and those are initiatives that we're looking at. And with that, I'd like to hand over back to the CEO.
Thanks, Otis. I think in conclusion, on page 40, it's clear to see that, despite the tough economic environment that we trade in, there's been a lot of productivity. One of the calls that I know sometimes take from shareholders is, are we taking our eye off the ball whilst we pursue merger discussions? And I think the answer to that is an emphatic no. If you look at our ongoing discussions on the refi, I think that obviously speaks for itself. I think that the fact that we've been, in this period, managed to bring slightly down the cost of funding, I think does speak volume for itself. I think when we do achieve and conclude on the 4 outstanding leases that Otis has already mentioned, I think we would have definitely seen a lot more progress than when we first started out in 2016 on the bulk lease renewal. And we must say that certainly, as one of the largest landlord to government, we've taken a lead position in engagements with DPW, and certainly I personally am having quite a few discussions with Neil Gopal at SAPOA in terms of some of the things that are on the agenda to be addressed with the minister and her team. And our first feedback or what we've seen from her is that she's definitely action driven, and the turnaround, particularly of those 2 major tenants, which of the 105,000 square meters that we spoke about earlier, that myself and the COO, is directly as a result of her intervention. Fund managers will recall that those tenants were part of the default lease category. We've managed to turn that around, and we are now positively looking at possible 5-year leases, which obviously, given the size of that building at 75,000 square meters, with both tenants having seen the CAPEX amount of work that we've done in the buildings, particularly in the fire, and the 30 million odd that we are about to kick off on the CAPEX on that building, they certainly are impressed with the level of attention that we are, despite our limited resources, that we are putting into that building. I think going forward, just to summarize, management's focus will continue to be on concluding the remaining bulk leases. I think we do need to formulate a plan around our CAPEX and TI that we've already committed. We do have those leases. They are signed. The clock is ticking for us. I think 12 months goes by very, very quickly. And I think we would like to show, a good gesture and good positivity. And certainly, some of our long-suffering buildings definitely, now that the leases have come through, do need some tender care from the CAPEX perspective. On the refi side, we have agreed with our funders to revisit the funding, the long-term funding proposition at the end of February, to obviously give the management slightly more time to conclude, particularly on the 4 leases, and let us see where the merger discussions do go. Obviously, I think we are not taking our foot off the pedal, but we want to be realistic. That we're not seeing truckloads of buyers from a disposal perspective. Certainly, the economy is such that there's very few buyers out there who can buy at the book level, a reserve price that we have put on some of these buildings, and it is important for us that we need to achieve the price that we definitely have some of the properties on the held for sale that we've basically have earmarked. I think filling of vacancies across the portfolio is going to be another key performance area for us. It's something that we're working diligently around the clock on. As Otis is saying, we are not only managing it internally, we have now basically broadened the scope to engage with external brokers and broaden the net as far as and wide as possible to make sure that we arrest the slide, particularly an increase in the vacancies that we've seen, particularly in Bloemfontein. Lastly, I think given where the comments that we've seen and the progress that we think we have made as a Delta, from a Delta perspective, I think if we are able to get the proposal and based on the comments that we've seen from those top 5 shareholders, and I must be honest, I think those comments have been robust. They've been firm from a Delta perspective in terms of what they would like to see, and I think we've taken that to heart. And I can assure all shareholders that we as a management team and the board would like to do the best thing for the fund, and we will only obviously continue on the transaction if it still makes financial sense. With that, I would like to close, and if there are any questions, obviously we'll open that up. I do know that our scrutineers are telling me that we do have a few questions. We will be addressing those questions that have already been emailed through, and I would suggest that if you have not done so, please email through, send through your questions, and then we will address them one by one.
Sandile, the first question is from Gershwin Long. He actually sent through 3 questions. The first one is on the 95,000 square meters that were renewed during the period, what is the extent of reversions on the renewed leases?
Thanks, Gershwin. It's Otis here. It's just under 5% on the 95,000 that we've renewed.
Second question is on the interest cover ratio breach. Your funders appear to be supportive. Until when has the breach been condoned? And please provide detail as far as penalties and fees are concerned.
Thanks, Mone. So, with respect to the breaches, the condonation is obviously applicable until the expiry of the next extension. However, with our engagements with the funders, these breaches will obviously be assessed based on the rates that are proposed if there's a further extension, or if there's a permanent facility renewal, then it will be a slightly different discussion. So with that being said, until financial year end at this stage, but obviously there's ongoing discussions. Sorry, and the second part was around the rates. So I think if you just look at the funding rates as we published financial year in Feb 19, you would have seen, especially on the net bank facilities, we did have some rates that as high as prime plus 4. So a lot of those rates have actually come down. Weighted average, if I look at Nedbank, at about prime plus 0.5%. And I think I must commend Nedbank on that. As a banker, they're really taking a two-pronged approach in the support to our business. One being obviously recognizing the 90,000 squares that we've signed, which has deleveraged a bit of risk. But the second prong is obviously to not penalize the business significantly with the higher rates and afford us the ability to retain some cash for CAPEX. So they are also taking a very, very keen interest in the portfolio, which is beneficial to themselves and stakeholders. So I think we must actually commend Nedbank on that.
Thank you very much, Sandile. Chanel. And then the last question from Gershwin is on the 2.8 billion rand extended facilities, how much lower were the rates offered relative to before the renewal of the 95,000 square meters? And can you give this in rand amounts?
Sure. I think to give it in rand amounts now will be a little bit difficult. I can prepare something to that effect, but Gershon, if you just have a look at our rates at Feb 19 was 10.2, and we're now down to 10. So the 0.2%, you know, if you had to just do a calculation looking at the 2.8 billion, you probably will come to a very good guesstimate around it. But that's the reprieve that we've got.
Thank you, Chanel. Then the next question is from Naeem Tilly from Seswikile Capital. He's asking why was the trading statement not issued given that distributable earnings per share was down 22% and the dividend per share was down 69% on the comparable period?
Thanks, Mone. So we did engage with our sponsors, and I mean, if you look at the JSE rules and regulations, especially with regards to the 15%, it's more applicable around the full financial year of the business. So I think at this stage there was obviously uncertainties because from an interim perspective there is no obligation on us to have any distribution payment. So that's more an assessment that will take place on the Feb 19 numbers, and if required we will issue a trading update once the numbers are finalized.
I think just as a follow-up to that, you know, I think on our previous roadshow with shareholders, I think shareholders definitely asked us about, you know, some sort of dividend policy going forward. What I can assure shareholders, and we've basically been discussing this with our banking partners, is that it's very crucial for us to retain our REIT status. That is quite important, and we wouldn't like to close off any options going forward, particularly as you see the economy going in a tough, going further regression in the economy. So we would like to leave our options going forward, and for us it's quite important that we retain that REIT status going forward.
Thank you, Sandile. The next question is from Wesho Nene from Standard Bank Group Securities. With so many of the bulk leases being renewed, the large negative reversions must nearing its end. Can you please indicate what reversion we can expect on the remaining leases as well as the month-to-month leases?
Thanks, Mwisho. Otis here. Mwisho, I think on the national ones, we should still be below the 6% reversion on the remaining 4 big ones. And then where we think we'll see more reversions is in the Polokwane provincial ones that I alluded to earlier. We're coming off a high base on those 3 leases. That should see our reversions going up. But on the rest of them, I think you can safely work just under 6%.
And then a follow-up question from Weshu. Please, can you give us more color on the office to resi conversions mentioned? Which buildings are being considered? Is this a sizable portion of GLA?
I think we've toyed around with it on the Sunny Hill node, but the offers that we got from the people that are active in the resi were quite cheeky, and that is why we opted to rather reduce our rentals and fill those up. I think where we will really take it into account is in an area like Free State, where our vacancies have gone up. So it is in Free State where we will probably be looking at doing those resi conversions. But we have not made much traction on that. It's something that we are now toying around with, given that our vacancies are increasing. We also know that from an education point of view, there's a shortage of student accommodation, and that is why we're looking at that. So it will probably be more in the Free State province as opposed to our other nodes, where we think we can still re-let at lower rentals.
Thank you very much, Otis. There are no more further questions from the webcast.
Thank you.
Well, thank you very much all for dialing in, and we hope to have more in-depth engagements on the one-on-ones as we go on the roadshow. Thank you very much.